seeing much of recovery. Yesterday, we saw the NASDAQ sell off by the most in one day that we have seen since February. Of course, the tech stocks have been what's taken us here to this point, most of the gains south of the border. But with a little bit of sell the news reaction on the earnings that we've got so far, and this rally that we're seeing in the bond market that makes some of these long duration assets perhaps look less attractive, is this a time for a pause on tech? Let's bring in Shane Obata, portfolio manager at Middlefield Capital, and Doug Clinton, who's joining us, co-founder and partner at Deepwater Asset Management. I know you gentlemen spend a lot of time trafficking in individual stocks and fundamentals, but I do want to talk about that macro backdrop because it does affect the sector. Doug, how are you thinking about the wobble that we've seen in tech recently?
Not that unexpected. I think when you think about, as you said earlier, the drive of what's moved markets so far this year, it's been all about tech. I mean, the Magnificent Seven, you can't get away from how strong they've been. NVIDIA, Meta up over 100% year to date. That's unprecedented, really, for companies of $500 billion to $1 trillion market cap. And so I don't think that we should be too surprised that we took a breather here. In terms of what we're doing, how we're looking forward into the markets, we do our best to try to ignore the day-to-day, try to ignore the macro, and focus on fundamentally what's happening with the companies that we like and that we invest in. And I think there are still pockets, even with this run that tech has had, where you can find some good value in companies that do have the characteristics of persistent growth. They can grow longer and faster than investors expect. That's what we try to invest in. I think you can still find some of those companies in markets today.
Shane, it sounds like from what Doug is saying is that stock selection maybe is going to be a little bit more important than a rising tide situation.
I think so. It's been a tricky week thus far with 10s over 4. That's something that we were talking about last week on the desk as a risk.
10-year yield.
10-year yield. But I would echo the point of the other guests in saying that it's about the long term here. And it's totally normal and natural to have some kind of a digestion period after the strong gains that we've seen. You mentioned earlier kind of the sell the news idea. That's exactly what we've been seeing in the numbers, in the sense that the sectors that have led this year, such as technology, are not getting rewarded for earnings beats on a one-day after basis, and then they're getting punished for misses. So I think it's just a digestion period and want to stay focused on the long term.
Well, let's use Shopify as an example. It was a mixed quarter. It definitely was not perfect. This is one you own?
No, not currently.
You don't own it. It has run up into the print, so we're seeing that kind of classic sell the news sort of situation. Valuation is something people complain about. It's still growing. It's growing quite a bit, 30% top line growth. What's the problem?
I think in this market, well, as long as interest rates are going to stay higher and as long as the narrative around inflation and rates potentially being in a new normal, that's not my base case, but as long as that's around, I think profitability is the key here. So for Shop, I think the long-term story makes sense. You alluded to the revenue growth, which is still good. I think forward guidance is still for over 20% for the foreseeable future. But we want to see better free cash flow, which we're expecting. And over time, it'll be that attach rate, I think, that really drives the stock higher, which is basically to say selling more services into the client base.
And we did see signs that at least the price increases are not scaring people away. The monthly recurring revenue grew. Doug, you don't own Shopify. You don't own Amazon either. Is that because of their tech stocks, but they're also attached to the consumer? Why aren't those stocks that are in your portfolio?
No, we like the consumer. We actually have been buyers of Melly more recently. So another consumer-focused leader, this one in Latin America rather than in Canada or the US. That's one where I think all three of these names we're talking about, Shopify, Amazon, and Melly, they're all these persistent growth companies that we look for. The difference to us is that Melly's backdrop in terms of valuation feels a little bit more attractive. And we also see a situation in Brazil where interest rates are low teens, inflation is low single digits. I think you're going to have an environment where central banks south of the border for us in the US are cutting rates, and you'll have a more accommodative central bank there that could help the Latin American companies like Melly.
Shane mentioned what we're seeing in earnings season is kind of a very tepid tone. If you beat and if you missed, you get run over. You're certainly seeing that in a stock like Etsy, which had disappointing forecast, I guess, for the upcoming quarter. And this is one you own, Doug.
It is, and it's one that we're sticking with. We're happy to stick with it. When we think about what has Etsy built as a business, we think they have one of the most unique marketplaces in e-commerce. The things that sellers sell on Etsy and the things that buyers are looking for on Etsy, you just can't find anywhere else. You're not finding them on Amazon. And so we think they have a unique and persistent business. And even though there might be a hiccup in Q3, they were sort of cautious when they talked about Q2 as well. So we weren't surprised that they offered some caution around Q3. In our view, you think about why is it pulling back right now? I think it's because largely in tech, a lot of expectations coming into the quarter were fairly high. We had this run up in most tech names over the past several months. And this quarter was much different from the past 2 quarters where I think expectations were much more muted in Q4 and Q1. I think expectations coming into Q2 for most of these companies were a little bit more hopeful. And so when you do have kind of that inline number and the business is fine, everything's going okay, we're not that surprised to see a sell-off on that news.
Are you picking up any of these names, Shane, that have been sold off on the back of earnings? I mean, PayPal is another example, but pretty much all of them have done worse after reporting.
We're largely just sticking with names despite some of the volatility. I think we may look to add, but the macro overhang for the next couple of months, I don't think you need to be in a rush here. But I do think that there's still value in the market, especially because I do think expectations were higher into this quarter. But if we're bottoming out for earnings growth and technology going forward, and there's some key areas that have been under pressure for a long time, right? We're talking about the basically hardware, phones, PCs. We see Qualcomm today.
Yeah.
This stuff has been in a bad place for a while. So if we're turning the corner, which is what we're starting to hear from some of the PC-related companies, and then hopefully Apple will provide some guidance towards that towards the September launch of the new iPhone. I think that can really lend some credibility to the rally and continued rally in tech.
Do you own Apple?
We do.
And?
I think you stick with it. It's a great company. It's something that we would view as one of those ecosystem stocks. So the story for us to Apple is really just the increased penetration of services over time. A lot of people, I think what kept us in the name for the years was rightfully noticing that the growth story was about the services side. So the iPhone revenue is, as a percentage, still 50+% of the business, still very important, and I'm not saying it's not. But that other part, I think, is really how you get more value out of the company over time.
It's not a name you own, Doug, here. Why not?
It's not, and it's a company that we love. I mean, we've trafficked in Apple for a very long time. The only reason that we're not, buying here is concern around the multiple. I think if we owned it, we'd probably be holding it. I don't think we'd be sellers. But as we think about new positions here, Apple's trading at multiples that are near sort of 5-year peaks. I think if you compare it to some other companies in tech that we do own, like a Google, like a Meta, where you have more reasonable multiples, and I think you're going to see higher growth from those companies over the next couple of years. We prefer that setup a little bit more to Apple, even though Apple is probably the best company in the world.
All right. Well, that's a ringing endorsement. Thanks so much, Doug. We got to leave it there. That's Doug Clinton and Shane Obata joining me on the desk.